All right. Just waiting for a few more folks to come in. And I've got my my partner here with us. And this is Miran. I'm Charlie. I'm sole partner at Brooklyn Bridge Ventures. And just to give you a little background, this new to VC series, oh, cool, it's a Kid Fest. So this new to VC series is basically something that I started 2 years ago, 3 years ago, maybe, pandemic time. Basically focused on helping people get a sense of like how venture works. And so the audience is a mix of people who are non-partners at VC firms, new and aspiring angels, and or those in the startup community that are thinking that, you know, this could be a path for them and they might want to join the venture side. They might want to raise a fund. You know, so this is sort of the behind the scenes. And normally we do panels and sessions, but this is something, this topic about, actually, I'm going to put her down because she's finicky. You can hang out over here, okay? I'll be right here. Okay. All right. You're just going to hang out right here. So, so this is a topic actually that is not something I hear a lot of other VCs like sort of focused on. And it's oh, what's the matter? What if I kept you bouncing? Okay. So my background is basically from the institutional side. So I come at venture from the perspective of the big dollars that comes in and funds a lot of the VC firms. And so I have sort of a different approach to this. So this is something that I don't think you'll hear that often from other folks, but I think it's been super useful from the perspective of how I planned my fund, and I'll kind of go into it. So I'm going to kick off the presentation, and hopefully I'm bouncing at such a cadence that Miran will pay equal attention to the presentation that you are. So, all right. Can everyone see my presentation? Yes. Okay. That's it. Thumbs up. All right. So, by way of background, we. Oh. Oh. Yeah. Okay, I'm just going to be louder than her then. So by way of background, I spent time at the General Motors Pension Fund on the institutional limited partner side. So most of what we did was fund investing. We did some directs. After that, I got a pitch from Union Square Ventures and spent 2 years there as an analyst. What's the matter? Not exactly cooperating. Grab her? All right, mom to the rescue. Okay. She's literally being dragged away here across the bed. So I spent 2 years as an analyst at Union Square. I did about 3 years of relatively unsuccessful startup stuff. Tried to start a company. I was a product manager for Union Square Ventures portfolio company, one of the few Union Square portfolio companies that didn't actually work out. And then I returned to my roots in venture in 2009 to become a principal at First Round Capital, helped them open up their New York office, and started Brooklyn Bridge about sort of 9 or 10 years ago. First money into the fund came in September of 2012. So, you know, look, the reality of VC is that there aren't a lot of partner jobs. And for whatever reason, VC has become an attractive field and people want to go into it. It seems cool. I think there are a lot of frustrated former founders that would love to be the person on the other side of the table, giving founders sort of a hard time, the way the VCs that they tried to pitch, has done. And, part of it, there's sort of an attraction to the independence of raising your own fund versus having to go apply for a job in VC or working somewhere else. So that being said, what's your fund going to be about? What kinds of deals are you going to invest in? You could have a good instinct as an angel, but you need a little something more to pitch with and a little bit more structure in what you're looking at to really kind of make this work. And this is where I think, the math behind it is really important. And this is something that I don't think enough investors actually get into. In fact, I would venture to say that probably less than 5% of all venture professionals have actually tried to model out, based on everything they think about the world, what their portfolio will actually net them from a specific cash flow perspective. And much in the same way that I believe that a financial model for a company is really sort of you put in all your assumptions about, how you think it's going to work, what markets you're going to go after, pricing and all of that sort of stuff. The same thing should apply to a venture fund. And I think not enough funds actually do that, especially when they first start raising, or same thing for angels, frankly, too. So what kinds of things actually go into it? So the key ingredients, and this is something that ultimately will be on the limited partner due diligence checklist, is what are your assumptions? What are your assumptions about, the actual deal? Where, what kind of check sizes are you going to write? Into what size rounds are you going to write them? And what's the valuation of the company, right? Are you trying to be the last $1 million to come into a $12 million Series A at a 50 pre? Or are you trying to get, mid-single digit, kind of valuations, and do pre-seed investing, and trying to buy sort of a certain percentage of the portfolio? So all those things are really important assumptions, some of which you can't control, right? Valuations are kind of what they are in the market, and you need to be realistic about what your assumptions are about going in. So, these are all, key points. Portfolio construction is another one. How big is the fund going to be? What's your pace going to be like? How many deals are you going to do a year? Are you going to follow on in these deals? How many rounds are you going to follow on? And then the third category is return expectations, right? What goes into return expectations? Mortality. Do half the companies make it from seed to Series A? How many companies make it to Series B? What's the expectation on an exit? What's your expectations on what kind of terms are on this fund? Your fees, your carry, how will that kind of work? For the moment, I'm just kind of presenting an overview, and I can sort of go down into each of these in more detail. Actually, you know what? I'll drill into a couple of these things now. Check size, right? Check size is sort of a combination of a couple of things. If you are raising from the perspective of starting a fund from scratch, check size may be a function of just what you're able to raise. And sometimes there's just a reality of for your first fund, or maybe even a second fund, X amount of dollars is just the money that you can scrape together, frankly. And that's what you're dealing with. And maybe it's not the ideal check that you would want to put to work, but it's what you got, right? And so it's not so much intentional as it is, from a, you're just dealing with the resources that you have. And that's fine, right? Like that's, you can't always control for that, and you kind of do the best you can there. But there are other dynamics of check size in terms of, when you have a little more control and intention, like what does your check mean for where you are in the round? If you're a seed fund and you want to raise $1 million checks, you're creating competition, right? You're basically saying, I'm going to be the biggest check in this round. Maybe we can squeeze one other check of my size in, but there are certain deals I'm just not going to be able to do because I'm not the first one that showed up with $1 million check, right? So you have to deal with the reality of your check size. Now, on the flip side, if you're an angel investor and you want to write 10K checks and they're not doing angel list syndicates or what have you, they might not stop to take your check, right? It may be difficult to get a 10K check into a deal unless you've got some specific expertise in the space or a reputation or what have you. I think a lot of times people are being a little more flexible with that, but there are sizes below which people aren't willing to take. Round size, kind of a function of stage a little bit. So, with what levels of risk are you going to be comfortable with, right? If you're going to be in the pre-seed stage, you're going to have to deal with a lot of companies that haven't launched yet, frankly. Is that something that you are comfortable with? And if you're not, then you're going to be at a stage where the round sizes are bigger and the valuations are bigger. What is that actually going to do to your returns and that trade-off? That's really important. For example, my fund, we probably do about 60 to 70% rounds that I guess traditionally you'd call pre-seed. And then the rest of them sort of seed. A lot of the seeds are ones in which they either skip a pre-seed round or really just do like friends and family. It's very small before they wind up raising the sort of $2 to $3 million round. And by doing that, I'm able to buy in at, in many cases, sort of mid-single digit valuations. But the trade-off is a lot of the times the company hasn't launched, right? And you have to make a decision to say, well, would I rather pay a 6 pre for essentially a PowerPoint, maybe a PowerPoint and a prototype, than pay a 12 pre for something that's got some traction? And what do I think about the relative price trade-off and the mortality rate, between those two? Is it worth it to pay up? I think is really kind of important to be intentional about and consider. Portfolio. Again, fund size, sometimes it's intentional, sometimes it's a build-up from the bottom up to say, I want to do this many deals, I want to do this much in finance and follow on. So, here's the math that it kind of came to. One thing that's important to consider on fund size is the raisability of certain sizes of funds. There are definitive like dead zones where, if you are going out for institutional capital and the institutional capital can't think in check sizes less than $10 million, and nobody wants to be more than 20% of a fund, in some ways more than 10% of a fund, there's just the math around it, right? That it makes a $35 to $40 million fund kind of hard to raise because, the bigger guys can't squeeze their check size into your fund. And on the smaller side, it takes a lot of individuals to raise a $35 to $40 million fund, right? So how realistic is your fund size relative to what can be raised? I think is another consideration that people don't always think about. Pace, not that people say, well, I really want to do a deal a month, so I'm just going to do the best deal I can find in any given month. But more like, am I, going to be comfortable with limited due diligence and early deals? Am I going to take some flyers on some founders that I just like and they don't have all the questions answered yet? But also staffing, right? It's like the more people you have at your fund, depending on how you do decision making, like the quicker the pace that you might put to work, and also the portfolio construction of, you may be overly diversified if you do 60 deals in the fund, because maybe you don't, each deal doesn't represent enough of the fund that in a good outcome, it returns enough for the fund, right? On the flip side, if you only do 10 deals, there's just a lot of shit that can happen in any given 10 deals in venture. So that may be being overly concentrated. And then follow-on strategy, which is really a dollar cost averaging strategy that a lot of people don't think of. I wrote a blog post about ownership and follow on that I'll share at the end. But I think you really need to think about how you optimize your returns for what price you're buying into the companies at. A lot of times you hear VC funds say how they made most of their money by following on. And that is mathematically true for most funds, because they also put 80% of all of their fund dollars into the follow-ons. So of course you're going to make more aggregate dollars in the 80% chunk of your portfolio when you only put 20% of the fund to work in the first check, because the first checks are smaller. But your multiple is going to be way higher in the earlier stages, right? Because if you bought in when the company was a 5 pre, and then they raised at a 50 pre, and then a 500 pre, and then they IPO'd, your best multiple return is going to be that first round. Of course, it's tough to scale that first round because they were only taking small checks at the time. So that's important to consider. And if you actually think about, since you can't control the outcomes, you can control your going in valuations. Mathematically, the way to increase your portfolio return is to buy as many of the cheap shares in the beginning as possible. It's the sort of buy low, sell high strategy. So that would dictate that your best returns are going to be in an equal weighted fund that basically puts all the money to work up front. Now, there's lots of reasons why you might not do that. One of it is maybe your fund size is just bigger than your ability to do that, right? If you're raising $200 million, like you can't put 200 million divided by 30 companies into, the first check and then just not follow on. There's market expectations on follow on, right? If you're writing $1 million first check, people are kind of expecting you're going to be there to lean into the Series A as well. Whereas if you're kind of a small angel fund, maybe they don't care as much. So there's other types of considerations. And then, returns as well. Like, what are you expecting out of these returns? And I'll go into that a little more sort of towards the end. And the same thing for mortality rates. I mean, the data is not great because, failed rounds turn into cost-cutting strategies. So you don't always know when a company sort of had a failure to get to a Series A, and then there's all these private companies that are essentially walking dead, but they're still out there and draining time and IRR. But so we'll talk a little bit about how to make certain estimates about that as well. Here's a bunch of stuff that we're not going to talk about, but that is also sort of could be its own session on how you organize your team structure around doing these deals. Decision making. Can anyone do a deal, or do you need certain critical mass of partners? Do you need consensus? What does that do to the amount of risk you're taking? Do certain partners count for more than others? Process. There's no reason for that process to have an extra S, but it is what it is. And then support, ongoing support, right? You should be making a budget for your time. It's very hard to do 20 deals a year and stay on the board of all of them and then do 20 deals the next year and expect that to work out from a time perspective. All right, so now we're actually going to talk about building the model. Some of you may come from financial institutions and be, the world's foremost Excel experts and be amazing at doing, Monte Carlo analysis and all this kind of in-depth stuff. We're not doing that here. The way I approach this is what I call a Schrodinger-Ventris model. For those of you that have ever casually dabbled in quantum physics and you're familiar with Schrodinger's cat, the idea that in any given outcome, until that outcome was observed, all of the potential outcomes are sort of still existing simultaneously. That is the easiest way to build the venture model. And I'll explain that in a moment. Okay, so I could have done a build up for this, but I didn't have time. So let's just take how you construct the model and say, okay, I'm a seed investor and I put some money into the seed round, and you decide how much money you want to put in. And I'm essentially paying $1 a share. And, it doesn't really matter whether you can sort of do the math in the background, whether it's a $5 million pre or, a $10 million pre or whatever, but you're basically saying, okay, well, we're just going to peg that at $1 a share. Now, maybe there's two outcomes, right, for a seed round. You can make it complicated and you can start to do, acqui-hires and, private to private sales or anything like that. You can make this model as complicated as you want, but you can say, okay, well, either we're going to raise the next round, and maybe in this scenario with a seed plus, or, maybe you're going from pre-seed to seed, or it's not going to work, right? And maybe from simplicity's sake, there's a 50-50 shot of either thing happening. The way I've built my model is basically said, each deal that I do will exist simultaneously in both the state where they have raised the next round and they have failed. So I'll basically say in month one, I have, $100 that I put into work at $1 a share. And that $100, there's a 50% chance that it gets bumped up to $3 a share, and a 50% chance that the company fails and it's worth nothing. So therefore, I marked that one company at $1.50 in a share, because I basically average out the outcomes, right? I don't know whether any particular deal is going to be the one that wins or loses. So I basically have every deal have all the outcomes averaged in every round. And so every deal is essentially a little microcosm for the entire portfolio. What it creates is a much more smooth set of portfolio outcomes than you will actually experience. But since you don't know which deals are going to be the winners, and we're not doing a Monte Carlo analysis around it, it just really simplifies the model a lot to do it this way. Because what we really want are portfolio outcomes anyway. So it kind of matters less whether the first one's the winner or the 30th one is the winner. That's something to just, make it a lot easier. And so we're really talking about expected value outcomes. So if you think that the mortality rate from seed to the next round is 50%, and you think that the valuation is going to bump up 3x, then you'll mark your whole portfolio, or at least that one company, at 1.5 times that, right? It's just the simple arithmetic of that. So your one company is sitting at $1.50 per share, because it's half dead and half successfully raised the seed round. You'll also want to put an amount of days in there. How long does that actually take? Because obviously time really impacts your IRR. So what we're really getting to as you build this up is a set of cash flows attached to dates. and interim valuations and all of that, right? So you say, okay, well, I raised my seed round, maybe 15 months later is when they raise the next rounds. And then it gets marked up at this point. You can throw another layer of complication and say, well, maybe it's 50% gets the next round, 40% is failure, 5% they raise a flat bridge, which is kind of dilutive. That's really complicating. You can do that. You can make it as complicated as you want. And then, maybe 5% chance of just a save, right? An instance where they built some neat technology and somebody wants to buy it, and you just get like $1 extra back or 50 cents on the dollar or whatever. And then you recycle that back into the portfolio. Again, that's the sort of next level of complication. I generally think it's probably easier to not build exits in until you start getting like actual like decent exits that affect the portfolio. Because the recycled capital, it's going to help, but it's not going to really make the difference in terms of your percentage outcomes. Okay, so now 50% of that company that's still alive, then another 12 months later, whatever, has another set of outcomes, right? And out of that 50% of the time, 30% of those outcomes, of the outcomes that are still alive, raise a Series A. And they raise a Series A at $8 a share, which could wind up being $40 million or $50 million, depending on where you started. Maybe 20% of the time, then they raise that weird pre-A round that's like $6 million, and it used to be an A, but now we don't call it an A, and that's at sort of $5 a share. And then maybe there's a 50% failure rate from there. And then maybe you can even build in the early exit scenario and all that sort of stuff. In that scenario that I laid out, you do that math around those numbers, and then you account for the fact that 50% of your portfolio is still dead. Those don't come back. Now you're at $1.07 a share for that company, right? Because it has all of the outcomes sort of baked into it, right? Then you go on and on, you go through each of those rounds, right? And then you just start layering companies on top of each other. That's when you bring in your deal pace. You say, okay, I'm going to do that every month or every other month, or 4 times a year because I want to do 4 deals a year or what have you. As you start layering these things on, then you have additional cash flows that come to bear, right? Because each time the company raised money, you have to make a decision. Do you follow on or not? Do you take your pro rata, right? So you got to figure out what your pro rata would be in that scenario, given the price per share. You make estimates around the round size. How much do you need to put in to maintain your pro rata? How many rounds do you keep doing that? You're going to want to build toggles, right? To be able to say, how many rounds do I follow on? I'm not going to walk you through how you should set up your Excel spreadsheet. All of you probably have your own view of doing this, and it can get sort of very complicated. I tend to do each round as sort of a new column. Then I do some very ugly cutting and pasting of netting each of the cash flows for an individual company in one single cash flow chart, which is a huge pain in the neck, but it's kind of the only way to do that because the cash flows are sort of unpredictable. So you make some decisions about follow-ons, right? What price are you going to follow on each of these rounds? Well, you have to pay the price of whatever you thought the round was going to do. And as you go in over time, as you build up some of these later stage exits, later stage rounds, you start making assumptions about exits. And when you get to the Series D and you're at a $250 million valuation, some of those valuations start to look good in terms of exiting, either from the perspective of the founder, like they get an exit offer that they're willing to take, or maybe you, where you're just like, hey, listen, when Tiger comes in at a $250 million valuation, maybe can I get out? Maybe that's my goal. Maybe my goal is to take half of my money off the table. Now that's not available in every round, and you don't necessarily control that. But you can aim for it. You can try for it. How successful you'll be, kind of really depends on the market. It depends on your relationship with the founder, but that's something you can sort of build in as well. So let's talk about exit assumptions, right? So if you look at Crunchbase, they did a study a couple of years ago, and they basically said that the average startup exit is a little under $250 million. And if you poke around and you look at some analyst reports, you get a lot of sort of 2 to 250 kind of averages. Now, a couple of things to take into consideration there. First of all, that data is all announced data. So it is not going to take into consideration the kind of failed sideways startup that built some tech that somebody picked up for like $5 million. Nobody announced that round price, so that doesn't really go into it. So there's a whole bunch of stuff that I, wouldn't necessarily say is being added into that valuation. But I do think that number is a reasonable target for like a pretty decent exit. Now, that being said, you may have a model in which you need way more than that. And that's fine. That is fine to say my model depends on finding unicorn exits. You just have to have a reason to suspect that you can actually do that and pull that off, and to say, well, listen, I have a strategy or a process by which I think I'm able to pick out the instances and the companies and screen out for the differences between the average $250 million exit and the IPO candidates. Maybe I screen for market size, or maybe I screen for founder ambition, or whatever you have. But I think it's just really important to be conscious of that. That's what you're doing, right? Because if the average outcome is $250 million, then like, just don't go out saying you're above average and you have no reason to be able to say that you're any more above average than anybody else who's also saying the same thing, right? So just very important to be conscious of that. Now, by the way, the average IPO over the same period, by the time lockups expire and VC funds were actually able to get out, I think the number was like closer to $500 million. The market is kind of very strange now because there aren't a lot of $500 million IPOs. So if you are thinking about the IPO route, clearly that's going to be a bigger outcome, but I do think you probably need to maybe add on some years in terms of how long it takes to get there. So what are the chances of getting a unicorn outcome? So if you Google around, you'll find an AngelList report that says a venture-backed seed stage startup has an estimated 1 in 40 shot, a 2.5% chance of becoming a unicorn today. So then you might go, oh, hey, well, I'll do 40 investments in my portfolio, and everybody else has a 1 in 40 shot. I got a 1 in 40 shot. I'm going to bake that into my model. Well, so there's one problem with that. The problem with that is, if you are the first money in, you are taking a company that is not venture-backed, and you are putting that in that category. And that's not quite what that previous stat says. And what I mean by that is, so the previous stat basically says, out of all of the venture-backed companies, 2.5% become unicorns. Now, of course, that's backward looking, and that doesn't necessarily mean that'll happen in the future or whatever, but let's just stay there for a moment. if you are leading the first round of a company, you are taking that company from the unwashed masses of all of the aspiring entrepreneurs who would like to be venture backed, and you are leading that round. You are putting it in that category, right? So you're taking it out of that big yellow circle, right? And putting it into the smaller red circle and hoping that it goes into the orange circle. But the percentage of unicorns that really affect your portfolio is out of all of the companies in your inbox, what percentage have a chance to become unicorns if you write the check for them? That's the percentage chance you have of sort of picking a unicorn winner. Once they're venture backed, then you could say, okay, if there's an existing deal where some VC came along and backed it and became one of the sort of 1% of companies that get venture backing, then maybe it's got a 2.5% chance of being a unicorn, in which even then I'm a little bit skeptical about those numbers. Then you say, okay, well, maybe that's reasonable, but that's not what you're doing. You're picking something out of your inbox and making it into a potential unicorn by venture backing it. So you're kind of fudging the data a little bit, right? And if you're doing a lot of deals and you're actually bad at picking, you could single-handedly impact that 2.5% number, right? So not everybody, not every company who gets venture backed has that 2.5% chance. That's just of who's been venture backed up to this point. You could be a better or worse investor than the rest of that and sort of nudge that number. So the idea that every venture portfolio is going to have a unicorn, I think, is somewhat suspect thinking. So time is really important. Exits can take 7 to 10 years. Sometimes you get them earlier. Sometimes, it happens later. There are lots of companies that IPO after 10, 12, Olo just became an IPO, I think it was 16 or 17 years. So you really have to take that time into consideration of how long that is going to happen. You don't always control the liquidity, but it's really important to build that into your model. Keep in mind the market, right? How are you building this model? Are you building this model for today's market, in which you might do a pre-seed round and a seed round comes 5 months later, and then an A round comes 5 months after that? Is that really the model that you should use when you are starting today, building out a fund that will invest over the next 3 years? So you're going to build a fund that invests today in 2022, 2023, 2024. Who knows what the market in 2024 looks like, right? And that 2024 company is going to be going out for a Series A in maybe 2026, right? So we don't really know the time horizons into that, right? So I think it makes more sense to basically say, what's the norm? What is the average? What is the thing we've seen both across good times and bad, and the 8 to 10 year exit, the maybe 12 months in between every financing, and then, hey, if I get more than that or better than that, that's gravy. But it's not something. At least I know what I'm assuming, and I'm not assuming that every market is going to be headwinds or wind at our back. Same thing with sizes, right? Which is hard because they shift. I'll tell you, the first time I ever built this model, a Series A, I put in as a $5 million round on a pre-money of 20 back in 2012. That seemed fairly reasonable, if not aggressive. That's obviously not a Series A today, and so I think those rounds have really kind of shifted. One other thing that is important to consider is your second fund, right? Okay, so you do all this math, you have this model, you're putting this capital to work over somewhere between 2 and 4 years. So then there's a question of, what does your portfolio look like when you go out to raise again? And what you'll probably find is statistically, it's unlikely that you have exits. Maybe you got a couple markups. Most of your portfolio is probably not marked up yet. So, you'll be going out to market with, maybe some markups, maybe a write-off or two. Probably not even many in the way of that either, because, if companies look like they're not performing well, maybe they cut cash flow, it takes them a little longer to go through that burn. So you got a couple of like zombies in your portfolio that aren't doing well, but they haven't been marked off yet. Not a ton to show for it, right? And so it's very easy for somebody to be like, well, I'll put some money out there and then I'll raise a fund too quickly or whatever, but you might not have a ton to show. So you want to be really conscious of that. Now, on the flip side, if you're like, I'm going to be very traditional about this, and I'm going to try and raise a fund every kind of 3 to 4 years or whatever, you'll have a lot more to show, frankly. And if you are going out for a fund 3 in that scenario, and you are 8 years into the process, you're really kind of going to know what fund 1 is doing, and whether it looks like it's going to be a good fund or not. And there's an expectation that like you might even have an exit or two from that portfolio. And if you don't, or you have a bunch of write-offs, or people look into that portfolio and go, I don't know, fund 1's kind of a dog, then you're just not getting to fund 3. And fund 3 is often the hardest one to raise because people having expectations around exits. Okay. So that was kind of a very quick overview. I'm happy to go in depth at any given time, but the first thing I'll do is look through the chat. So the first question I got was on mortality rates and exit sizes. So first of all, on mortality rates, I think that it is very helpful to talk to other VCs and ask them about what they are experiencing in reality. I think what you'll find is that companies die less and more painfully than you'll always assume. And what I mean by painfully is very few, like a lot of times they're able to make some forward progress, and there's always like some new investor that is like, wow, that seems kind of cool. Yeah, I'll pile into that last round. Oh, was it last year's valuation? Yeah, I'll come in. It sounds like you're right around the corner from turning this thing around. And so what winds up happening is you get diluted with some bridge rounds, and maybe they do turn it around, but or maybe it just kind of keeps going sideways. And so actual fast mortality and clean mortality, where you raise a pre-seed round, just doesn't go anywhere and it just dies right away, is actually like fairly hard to come by because founders are persistent and they'll just kind of keep making it work for a little while. So a lot of times you wind up having these inflated portfolio valuations where you just haven't seen a lot of zeros in the first couple of years. What's really what I would encourage you to drill down more on is what's actually the percentage of them that get to that next stage, and how many interim rounds are there? Is it likely that you go from seed to Series A? Is there an interim round in between? What does that round look like? What's the reality of valuations in that round? That's the key. A lot of times you hear about crazy valuations, but you don't hear about the pre-A round that was 5 on 15. Which, by the way, if you have an opportunity to raise $5 million and you can do what you need to do to become a big company one day, that's great. It's a win, right? But like, people don't tend to bake those types of rounds where you get 25% dilution additionally post your seed before you get to Series A into their assumptions, right? It's very easy to think that because you came into a round at a pre of 7, that the company that raises $80 million at a Series A is like a 10x markup. It's not a 10x markup because you may have had 2 interim rounds in between, one of whom may have been fairly diluted. So you're sitting there going, wait, I got in at a 7, they're raising at an 80. and somehow I'm only up 4x. Like, what happened there? And that can be the case, a lot of times as well. Again, on potential exit sizes, it is really reflective of what you're going after, and frankly, like how smart you think you are, and the quality of your deal flow, right? Do you believe that you have an outsized chance at getting a bigger outcome? And why do you believe that? And why do you believe that relative to everybody else who's going after the same stuff that you are? Do you have any, inside track to deal flow that other folks don't have? I think it's very hard to imagine yourself as a better picker as a first-time fund, unless you have something sort of systematic where you're just like, yeah, I got special access to Cornell runway deals, and I think those are better, and here's why, and all that sort of stuff. You got to kind of be honest with yourself about, what you're doing. My personal standpoint is, perspective is, I've been in venture for like 20 years now, and I just assume I'm average. Like when I build in portfolio outcomes, I build a portfolio perspective that, like, if I get $250 million outcomes, my portfolio can still turn out a good return. And I try and think about it like that. And if I get, the occasional odd, like, pedal or hungry or whatever that's, valued way above that and should exit way above that, like, great, awesome, gravy. But I don't necessarily make those assumptions that that's gonna happen. It feels like there's a ton of nuance and divergent perspectives around first check and reserves. Curious, have you thought about this and how your thinking has evolved over time? Okay, so I think there's a big difference between whether you're going to act like a small fund or a big fund when you're thinking about reserves. Personally, I think if you have a fund that is, let's call it $15 million or below, I don't know why you're bothering following on. You just wind up paying higher prices. No one expects you to. I mean, maybe if you're like leading really early rounds, people want to see you write another check. But even then, if you're like a small kind of angel fund, Sequoia comes in for that Series A, they do not give a shit whether you're following on or not. They want to get their 20% or their 10% or their 15%. And frankly, it's easier for them if you're not following on. Probably even easier for the founder if you're not following on. And if you need a bridge and the company has not made enough progress to get money from others, you and your dinky little angel fund can't be counted on as the big check to save them. I mean, you're the last person around the table. So I think as a smaller fund, you're just so much better off buying as cheap an equity as you can get away with, right? Buy the cheap shares, because when you have that $1 billion exit, would you rather that 3% of your fund be invested in the equity when it was worth $6 million, or 1% of the fund be invested in the equity when it was $6 million, and then the other when it was, $40 million and then $140 million? That really makes a big outcome on your portfolio. So if you're small, I think you want to buy the cheap shares. If you're larger, the money's going to force you to buy in at higher valuations. You need to put the money to work. Do you have to put it to work forever? No, not necessarily. At First Round Capital, we were $130 million fund. I think kind of like stopped investing definitely like sub $100 million valuations. And I mean, at the time that may have gotten you 2 or 3 rounds. Maybe now it only gets you, kind of 1 or 2. But our model was sort of built on that we were going to lean in heavy to the A. Maybe we'd continue with the B, and then we were kind of out at that point because we didn't want to buy in at sort of higher valuations. The other thing I think is important to consideration is, where do you think the mortality will happen? So if you believe that there are a lot of like not so great companies that are being artificially propped up by Series A's and Series B's that like shouldn't be happening, then like if you lean hard into doing your pro rata in those rounds, and 2/3 of your fund is in uh, follow-ons, then any late mortality or unexpected mortality is really going to impact your returns a lot. Because then you like leaned into a company and then it went out of business. And like that shouldn't be, right? The whole point of paying up for later rounds is such that like you're assuming these are the best deals. You know, like that's you know, if they're not, then you're overpaying for them and you're putting too much of your portfolio in them. So again, like I default on equal weighted bets. I'm like, I don't know which company is going to be the winner. If I did know which company was going to be the winner, I wouldn't do the other ones. And I try and get, you know, as many cheap shares as possible so that, you know, I'm not leaning in too hard if something goes out of business later on, right? Like I was early, you know, I was the largest seed investor in the wing in my first portfolio, and then we got hit by the pandemic, among other things that we got hit by, but I didn't follow on. So I only had sort of 1/30th of my fund, 1/35th of my fund in that deal. So I got hit a lot less than somebody who like leaned in when it was a really hot company and thought they had a really big winner there, and then it took a chunk out of their portfolio. I'm going to stop sharing for a moment because I want to be able to handle any live questions that people have. If anybody wants to raise their hand and bring up something that like wasn't in the chat, I'm happy to discuss that as well. But I will share the deck, share the recording. It looks like we got another chat question here. How would you build in SPVs into the model? What if you decide you'd like to build in SPVs at Series B? So like I wouldn't build them into your core fund return model. I think of SPVs as more of an asset management strategy than a return strategy, because you are kind of carving them out from the main fund. I think for the most part, if you're creating an SPV and you're asking LPs or other folks to lean in to the SPV, you're just kind of giving yourself more optionality, to get carry, sort of a multiplier effect on your dollars. But you know, the thing I would just be careful of is, again, like, how much do you think you know at Series A or at Series B or at Series C? If you sort of imagine like the average company that's getting a Series B right now, how sure are you relative to what you thought about the company at the beginning that they are a likely $500 million exit or IPO candidate or whatever? And I think you'll find that you're not as sure as you thought you would be at Series B. That you know, obviously feels good to get a markup, but when you're an insider in the company and you're just like, oh my God, there's so much broken stuff still in this company, and somehow somebody's paying $100 million pre for this. The idea that like you're really doubling down on your winners, oftentimes it doesn't quite feel like that if you're really honest with yourself. So, and I think you need to be careful about that with your managing LPs, because if you've got somebody that puts $250 million into a sort of, sorry, $250,000 into an angel fund, and then you come at them and you're like, listen, I'm doing an SPV for this deal. It's my Series A, Sequoia's coming in. It looks like a winner, blah, 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 whatever. And then, you know, they write $100K check for that SPV, and then that company just goes off the rails and tanks. It's very unlikely that your diversified fund return that is divided into 30 companies is going to make up for that $100K they lost in your SPV. And when they're considering whether to be in fund 2 and fund 3, they're looking at the whole of the money they spent on you, right? And so like literally almost half the money they put in the fund, they lost on one deal. So, you know, look, if that one deal turns out to be a winner, they're going to keep piling money on. but you're ratcheting up the risk of each LP coming back when you start to do LP co-investing and having people kind of lean in. I do open up my deals to co-investment in my fund for my LPs, but I don't collect any fees and carry on those deals, and I have them come directly into the portfolio. This way I can kind of be hands off about it. And I could just be like, look, we came in at the seed. I like this company. I think they're doing good work. This is up to you, right? Like you're making this choice. You're managing this. I'm not managing it. I'm not taking a cut. This is a bonus for you. It's bonus deal flow, but don't count it in my track record that I showed you the Series B. That's in your court, right? And there's some people who might look at that and going, geez, you're an idiot for leaving that money on the table. You could be making carry, all of that sort of stuff. I'm literally taking stress off the table because I'm not managing. People ask me like, oh, how do you feel about being in that company? I feel great being in at a 5 pre. I might not feel so great if they were doing $6 million in annual revenue and they just raised at 300 million. And that's the dollar amount the SPV came in. Like, I don't know how I feel about, coming in at that stage. Seems easier to optimize your portfolio if you're stage focused. If your investments are stage agnostic, like late stage, which tend to be larger, that'll dominate your performance no matter what. Thoughts on that? That is a really good question, actually. There's a couple of things to think about when you're stage agnostic. I mean, from building a model, it makes things a lot more complicated because you don't know which stage deals you will do when. So then you're going to make that Schrodinger's cat thing even more complicated, right? I tend to think that you're kind of probably better off thinking about barbell strategies in that case, that like you have a specific chunk of the fund that you actually manage almost like separately. Actually, that's the way I would think about that. I would think about multi-stage portfolios as if they were separate funds. And I would think about allocating across separate funds where I've got like 20% of my fund or 50% of my fund or whatever that basically operates like a pre-seed angel kind of fund and has its own sort of return expectations. And then I've got a late stage fund, right, where I'm putting in, and I expect outcomes within sort of 2 to 5 years, and I my mortality rates are less, and I would just model those two funds out separately and then sort of allocate between those two funds as you went along. I think it's really complicated to mix them and sort of in any rational way think about the blending of like, a single digit pre for a person in a PowerPoint versus coming into Figma's last round. Like, I don't know how you square those two. I think you got to think about those as two separate portfolios. Any brave hand raised live questions that anybody wants to jump in at? Feel free to use the little hand raise feature. Nobody. Come on, you can't look worse than I look in the beginning with my daughter screaming and flipping out. So, speaking of bravery, I'm not surprised that Maya's going to jump in with a question.
Hi.
Maya's an awesome Twitter follow, by the way.
Thank you. I love your daughter on the call and the photos on Twitter and things like that, but I do have a small recommendation. There's a very cool thing called CRISP, KRISP.
Oh, is that the thing that drowns out background noise?
Drowns out background noise.
Does it work on babies?
Babies crying, construction noise, and for me, my dog is barking and going crazy like half of the day. I literally just, nobody knows. Good rec. Just cuts it to zero.
I will do that. I also, by the way, it's not just the noise. I want her to be attended to, and I don't want to just ignore her while she's crying. Like she has needs. We would like to satisfy those needs. Is it just a rec, or did you have a question?
I do have a question.
Okay. Cool.
I feel it. So I really liked how you dug into each of those 3 columns about like, these are things that LPs are going to be interested in, and here's how to think about them. I feel like you kind of rushed over pace a little bit. And that's actually one of the things that I'm thinking of doing a specific fund that only invests in alumni from my college. and it's a very small college. And so that's the feedback I've gotten most from LPs is they're like, the pace is not going to be fast enough. Like you've modeled out, you're only doing a couple investments per year. It's just not going to work. Can you speak to that a little bit? Because my
Sure.
assumption was you could finagle like capital calls with a slower pace to kind of make it work out. And it seems like that's maybe not the case.
That's a really, really good question. Yes, I did blow through the pace. One way that I would think about doing this is the same way a lot of public market investors do when they think about portfolio strategies is back testing, is to basically say, okay, had I had this fund 5 years ago, 7 years ago, or whatever, what deals would I have done? And again, you have to be pretty honest about like, had I had this fund, would I have gotten access to that? Like, am I a LinkedIn connection away from that person? If that person graduated from my school, would they have thought to go to the fund that is attached to the school? Would that have been attracted to them? Yes or no? And so, you know, somebody pitched me on a recruiting related fund, right? And you know, I basically went back at them and I was like, okay, well, had you had this fund, what 30 companies would you have done over the past, you know, 5 years to put together a portfolio? And by the way, I keep using numbers like 20, 30, 40. Finance 101, if you're talking about like diversification and eliminating unsystematic risk, basically says that like somewhere between 30 and 20 and 30 is where you minimize the unsystematic risk of the random shit that can happen to you when you don't diversify your portfolio properly, and you don't get paid for that risk, right? So you kind of want to build a portfolio of, I would say, at least 20 deals. So again, like, were there 20 good recruiting related deals to do in the last, you know, kind of 4 years? And why the 3 to 4 year time frame? Like, to your point, like maybe you only do a couple of deals and you do them less frequently. I actually think that's fine, except that you have to be really careful about fees, because fees are based on commitments and fees drag, right? So if you're taking 7 years to put the portfolio to work, you're actually overcharging fees because you're literally doing less work. And so if you want to make it a fund that just is a budgeted management fee, and where you're just like, look, I have a full-time job, it's a little side gig fund, I don't need to get paid a current income by the fund, I'll just pay for, you know, the basic legals and accounting and whatever. And you can really be flexible about that, by the way. If you're putting together an angel fund and it's just, you know, friends and other people, and it's like super early stage deals and it's like less than a $10 million fund, don't do an audit. Like, that's crazy town to do an audit, because the percentage chance that like something actually comes up in an audit versus the percentage chance that your kids coming out of college that have never run a company before actually just suck at running a company, when you actually think of like where your risk is, you know, the audit does not pay to eliminate enough of the risk. There will either, and again, you're not leaning into these deals, right? So you're writing the first check, there's nothing to really audit at that point anyway. And so all you're really auditing is like performance for the next fund. And the reality is, as much as you, for GAAP standards, are supposed to be like, what do I think this company's worth or whatever, you're kind of doing whatever the valuation of the last round is. You know, Sequoia came in, marked it up to $200 million. Like, you'll write up something for the accountants that says like, yeah, I think it's worth $200 million too. So I think you could do overkill on some of the administrative expenses of it. I do think it is worthwhile to get a fund administrator, especially when you have a lot of LPs, because that's just a pain in the ass. And it's, you know, if you're not full-time at it, it can take up a lot of time. I happen to use Carta, and they've done a really great job for me. But yeah, so you can do an adjustment on the fees. I think maybe you can kind of make that work. But the other thing is, if it's a long time horizon, and you have individual investors, you want to be really careful about commitments and whether you draw those commitments down up front. So some people, when they take on smaller investors, they say, hey, give me the money up front because I don't trust that you're going to have the money 3 years from now when I do a capital call. I had 68 LPs in my last fund. I had that happen once, that an LP fell behind and nearly defaulted. Somehow he came up with the money, but I had a nudge a bunch of times. The problem with that is you're basically stuck between either I trust that they're going to have the money 4 years from now when I'm making the capital call, or if I take the money up front, but I don't put the money to work for 4 years, then you're just sitting in cash. And those guys would default to just keeping the money in the S&P 500 or whatever else they're doing. So you really can't have super long holds. And then the longer the commitment, you know, the less chance that money is going to be there in the future. So it's kind of a tough thing. With alumni ventures, what they do is they just do these like annual funds. And, you know, you commit to a certain number of their annual funds. The annual funds may actually have like less deals in each, but if you know that's going to happen, and it's basically almost set up like they're outsourcing your angel deals for you, where you know you're going to be in less deals, but it's probably more deals than you would have been if you're a regular angel investor. So, you know, look, maybe at the end of the deal, you only get 12 deals, but if you're also doing 5 to 10 deals on the side as an angel, maybe you just use this as a supplement, as a complement to that. But my recommendation to you actually would be like, does it only have to be students? Can it be alumni? Can it be, you know, deals that are being led by VCs who graduated from your school? Like, a good deal is a good deal. And if something floats across your pipeline, I wouldn't be overly strict about like fund definition. We got another hand, DK.
Hi, Charlie. How are you doing?
Good, how are you?
I'm good. My daughter turned 26 recently and got her MBA and paid for it herself, so I wish that upon you.
Thank you.
Sitting where you were that long ago, I couldn't even envision her finishing high school, but it does move. The time, you know, flies by. Enjoy every single moment of it.
Thank you.
I was going to ask, I mean, this is all about finance and all, but where do things like allocations of board seats and votes, how does that kind of influence this?
So that goes more into that second slide that I had done on sort of org structure, process, or whatever, which is a whole, and we will do one on org structure this year. We're sort of inviting folks on. So the only thing I would sort of say is that, look, the more complicated you make your decision-making process, the more it's going to affect your pace, right? And so if you need, you know, 4 partners to agree on something, it's just very unlikely that you're going to do 20 deals this year. And you got to be very conscious about how decision-making structure will impact pace. If every partner has to see a deal, that it will impact your pace, because it's just scheduling. It's just really hard, especially if not everybody around the table is full time. Again, we'll go into a little more. I do make a sort of time budget for board and board-like seats. So I have a nice little chart where I map out in kind of a Gantt chart looking thing as to like how long I stay actively involved on a company. And then as I layer each company on every quarter, I kind of look at it and I'm like, oh, that line's getting kind of thick, right? Like all of a sudden I have a lot of companies. I got to get off some of these because I just don't have enough time to give each company the kind of time of day. And so I try and be as strict as I can, especially where I have good partners, right? There's some boards where like I haven't been to a pedal board meeting in like 2 or 3 years. And as fun as that would be to kind of keep hanging on, they have great partners and there's lots of people around the table. I'm still an observer. I could go if I wanted to, but I like, honestly, I just don't have the time considering the deal pace. So you need to be careful about that.
Okay. Another question.
Sure.
Different topic. We have the opportunity to lay off money into I guess for lack of better, brick and mortar service businesses that will never be acquired. They'll never be IPO, but they are profitable. These people are earning money. And so what about like a balanced or a mixed portfolio where you lay off some of the cash into these, I literally call them cash flow businesses. They're not going to be acquisitions. They're not going to be IPOs, but they're doing 10 million revenue gross and netting 3.5 million. I mean, really profitable businesses.
Look, I think that's totally fine. And you can apply this to any kind of investing in any kind of portfolio. Again, when you're mixing things that have very different return outcomes, I would model them as separate portfolios that you allocate in between. And so if you've got, a bunch of retail, restaurant, CPG businesses that, you have a rev share in them, and they'll have their own sort of outcomes. I think it's fine to basically throw a dividend tail into, that like, I invest in this company and in year one, it pays out the dividend I expected it to. And then 50% of the time it doesn't actually, but it's still alive. And then, or 10% of the time it just goes under. And you can do that same kind of analysis. It just winds up meaning you get more cash flows back. And then you have to decide, it makes the choose your own adventure thing even more complicated, because then you have to decide, okay, the cash I get back, do I take it out? Do I put it back in? What does that mean for cash flow requirements and stuff? But I would just model out different performing securities differently and then decide how much you want to allocate in between the two of them.
Thank you. Very helpful.
Miss Lowry is next.
Hi, Charlie. I was just going to ask what your thoughts are on like open-ended funds, like the evergreen structure that Sequoia's now baked in. And I have seen at least one early stage fund go evergreen.
Look, there are different flavors of that. So like, I don't know exactly how Sequoia is doing their calculations. Where it really becomes an issue is like, how predictable are your commitments, and how steady are those commitments, and when can they bail from the fund, and then how do you get paid, right? And how does the carry structure work? And so, with a basic GP LP fund where you get a fund, you put the money to work over 2 to 4 years, and it takes 10 years for it to come back or what have you. The nice thing about that fund structure is that it ends, right? Like there's $10 million of commitment that went into this fund, and that the second the $10 million gets sent back to your LPs, you start getting carry. Like it's just very clear and it's very clean, right? You start playing around with these fund structures, and it's like, well, I put 10 million out this year, and next year, and the year after that, but then the 10 million started to come back from this year's fund. So do I take a carry on that? Can it get clawed back? That's where that starts to get a little bit messy, a little bit hedge fund-like in terms of, how profits are taken, whether it's deal by deal carry. And by the way, folks may not know this, but when you do a fund structure, typically you have to return all of the capital that your LPs have given you before you take a cut of the profit. So if I have a $15 million fund, I have to get $15 million in proceeds to go to my LPs before I could ever take $1. Now, meanwhile, I have some management fees that I could use to pay a salary and keep the lights on in an office and hire an analyst or what have you. But that's the way that part of the fund works. If you're doing SPVs, or if you're doing other types of structures, you may be doing deal by deal carry. So what that means is I take 100 grand from you, I put it to work in a company, I double it in an exit. I take another 100 grand from you, I put it to work in a company, the company blows up, I lose all your money. In a fund structure, I have only returned your capital because I doubled the first 100K, but then I lost the next 100K, and we're at zero now, right? And I can't take any profits. In a deal by deal carry structure, I take 20% of the profit from the first one, and then whoops, the second one I lost money. pretty good deal for me, pretty crappy deal for my LPs. That's why a lot of people like doing SPVs. Now, the downside to that is you do some SPVs and let's say the first 5 deals suck. What are the chances that people are going to sign up for deal 6 or deal 7, right? When you have a fund and you have commitments, you allow the possibility that the best deal is deal 20 and the first 19 deals suck. But then the next one is an IPO in 3 years and you're just like, all is forgiven. And you forced people to stay with you. How that works in the evergreen funds and the annual funds and the rolling funds and all of that sort of stuff. I don't think people are accounting for the shakiness of limited partners who can get out in a down market. I think a lot of people that are raising money in rolling funds haven't seen a down market. Stock market goes down 20% next quarter and your rolling fund's going to disappear, right? And you're just not going to have a fund to put to work. And that's actually when you want it, right? Because the valuations come down and now all of a sudden you're not paying crazy valuations. You're paying what you paid 2 years ago on a deal, right? Now, Sequoia is a little different. Sequoia's got long-term capital. Sequoia is going to have money from the Ford Foundation for the next 40 years, basically. And so they don't necessarily have to worry about that. So they're basically looking for a different type of deal with a longer hold, longer term LPs. They're saying they don't want to exit. That could work out really well for them. I don't know too many other people that can get LPs to sign up for 20 years and have that kind of capital base. I mean, that's the nice thing about being Sequoia. I'll give you a quick little anecdote. As it turns out, Don Valentine, the founder of Sequoia, is actually also a Fordham grad, which I found out very late and did not know when I was teaching entrepreneurship there, which is really funny. So I got an opportunity to meet him before he passed away a couple of years ago. Just cold emailed him. Just like, hey, Fordham, right? And he's like, oh, that sounds really nice for you. If you're ever in the Valley, come by. Now, and what I realized is that very few people probably emailed 80-year-old Don Valentine and wanted to meet him. And when you were a VC in the 60s and 70s, no one even knew who you were. So if somebody even found you, you were probably a legit MIT scientist and, a real, decent founder and probably worth taking a meeting with, as opposed to today where your email address is all over the place and it's kind of a free-for-all. So I thought he was going to be all excited about the Fordham connection. 2 minutes into the meeting, he's like, yeah, Fordham's a really long time ago. I really don't remember. It was before I moved out to the West Coast and actually built my career. So I had nothing after that. He was very kind. He was very curious about how I did things. And so when I told him I had a fund that was New York based and had a lot of individual LPs in it, he bristled about the idea of individual LPs. And he's like, oh, individual LPs, that's terrible. I said, why? And he's like, well, they're very unpredictable. They die, they get divorced. We've had money from the Ford Foundation since 1970, and they just give us money anytime we want. And I was like, that sounds great. I would love to get in on that. If you could have an LP base like that, like sign me up for the Sequoia LP base. But I'm just working with what I can get here, and I was not lucky enough to have that kind of LP base. But good for him. Any other questions? Oh, Mitchell.
Hey, Charlie, thanks for doing this. Quick question for you. So I'm spinning up a syndicate that's just comprised of leading corp dev management and operators across high tech like SaaS companies. So it's like me, the Uber guys, Plaid, and then a variety of other SaaS companies.
The individuals, not the companies.
The individuals, yeah,
Cool.
yeah. And so we're obviously working through some of the conflicts of interest there and whatnot, and making it pretty clean. But the question for you is, we have a lot of funds that are interested in like trying to work with us to share deal flow back and forth, given the roles that we have at these companies. And is there some logic there in terms of how many funds we could reasonably work with to be sharing deal flow? Because obviously if we pick like 50 funds, then it's just really a mailing list that we're sending deals to. But I want to keep it tight and keep the depth better than having 50 funds. So the depth of connection. So how would you think about that? Like, how many funds would you work with if you're a syndicate?
So first of all, I love that model. And I am a really, really big fan of models where everybody who is an LP is basically doing the same job across a bunch of different companies, because you then become the go-to for anybody who cares about connecting with that group of people. And if you're like, we have all the individual corp dev people at all the places that ultimately you want to buy you, that's a very valuable group of people to have on your cap table. It's not a very accessible group of people. I think for them, it's really valuable because, you know, like they take as many meetings as they can, but like having somebody out there who's essentially kind of, you know, democratizing the flow of you know, deals, I think is potentially really interesting. It's funny because if any companies feel like that's a conflict, I think they're being really short-sighted. I think you want that conflict. I think you want to be in that pool versus not. Having funds in there, I think that's kind of overplayed, to be honest. The only person I know who actually does that really well, what's the guy's name? Is it abstract? No, it's not abstract. It's there's a fund that I'm in the first round of battle with. Now I can't think of the name.
Is it Better Tomorrow Ventures?
No. This is a person who has basically gotten GPs at all of the top venture firms, top, you know, brands, whatever the imaginary list of the top 30 funds are or whatever. And what he basically does is says, look, you guys don't have time to do seed really well. Occasionally you do seed, but like, you know, you just do it to track and signaling, and you're not even doing that particularly well. So, but anytime that any of you do a seed, we'll co-invest with you. But what we'll also do is we'll ping each of the companies in the portfolio, and with very simple data requests, like how many employees do you have, and like what was your revenue, and some really basic stuff. And then you as a GP could subscribe to data from particular companies or from the whole portfolio, right? So you get a sense of like, whoa, hey, look at that company, like they're suddenly getting, you know, some traction. I might want to come in on that. So it was like set up in a way to be very structured in terms of how to take advantage of all of the LPs and create a positive dynamic for the fund. So if you didn't have like a means by which you were letting the funds know about what was in the portfolio or co-investing with them, and it wasn't something where like, you say mailing list like it's a bad thing. I mean, like a lot of the goal with this sort of stuff is to create heat around my portfolio companies and let the whole valley know that, you know, or all the New York VCs or whatever know that like you've got the hot company in your portfolio. So like, that's not a bad thing. The only thing I'd be a little careful about, and this is why, you know, you got to be a little careful about information sharing, is like, you never know who's in what deal. And if you can't share the information, then is it really actually valuable to kind of have them in? And then I think a lot of founders are a little skeptical about, you know, like everybody's got a scout program, everybody's a scout. And if you're like, hey, we're a feeder fund for X, Y, and Z, the best founders are like, I don't need a feeder fund to be on my cap table. If I'm quadrupling my revenue every month, you know, such and such, Excel's going to want to look at me anyway. I don't, you know, you're so far removed at that point. So I kind of feel like either you have all of them or none of them, and you need a structure to make the information and deal sharing work. Otherwise, like, it just feels like wonky. Now, that being said, if you just like can't raise enough from the corp dev guys because they can't write big enough checks, and you want a $20 million fund or a $30 million fund, and you got a couple of funds that are like willing to write you bigger checks, like, fine. I mean, you just may need the money, and that's fine too. But I don't know how additive it actually is, or subtractive. I just don't. I think it's kind of neutral.
Gotcha. Thanks for your time. It sounds like you were also talking about maybe Shrug Capital. I'm not sure that was one.
No,
LPs.
I'll hold on.
All good.
I'll
Thanks
get
for
the
your-
name and follow up. But if you email me, I'll find the name.
Cool.
Anybody else? We got 3 minutes before the amount of time that I said I was going to take out of your day. So maybe last question before I relieve my wife, who is very graciously watching our daughter at the moment. All right. Well, listen, like we are going to add all of you to our list of events for the year. We're planning a lot more new to VC sessions. We'd love for you to join in the future. And if there's any topics, questions you have, please feel free to email me. It's charlie@brooklynbridge.vc. Just so you know, in terms of like deal flow, I do New York City-based deals, New York City area-based deals that have yet to raise $750K in a prior round. So that could either mean I'll do a $500K pre-seed round with me and a couple of angels, or I'll lead a $3.5 million round with a fly paper term sheet where I put down some terms and I'm not the biggest one in the round. I'm actually in the process of leading that now, where it's my term sheet and there's 1 or 2 people coming in with like $1 million checks next to me on my terms. So I'll do either of those types of deals as long as they're in the area. And generalist, I don't have a particular area that I focus on. And yes, I will do a Web3 deal, because I guess you have to carve that out extra as like identifying yourself as being willing to do that, whatever Web3 means. All right, thanks everybody. See you guys soon. Have a good day.